Thank you for joining us today for a lively discussion on how digital lenders are being hit with high fraud costs and challenges they face with digital identity verification. Our speaker today from LexisNexis Risk Solutions is Kimberly Sutherland. Kim is responsible for identifying and guiding LexisNexis Risk Solutions technology response to the constantly evolving market needs for identifying, proofing, and authentication in commercial and government organizations. Our other speaker is Chris Ryman, Vice President and Principal at KS&R Global Market Research. Chris has a broad consulting background guiding clients in the risk management and technology sectors with market opportunity analysis, fraud and financial crime assessment, customer needs exploration, and new product service development. Also joining us is Zach Tondre. Zach is the Director of Market Planning for the Digital Economy. Zach uses his 14 years of experience in credit unions and mortgage banking to guide his market strategy and practical applications to solve for risks across the customer lifestyle. And before we begin, a few housekeeping details. One, for optimal audio experience, please join the flash option on your settings in the upper left-hand corner of your screen. Second, please submit questions through in the chat room. Kim and Chris will do their best to answer all questions. In the event that we run out of time, they will follow up with you via email. And now over to you, Chris.
Thank you, Kelsey, and thank you to everyone. We welcome you to our webinar. My name is Chris Ryman. I am with KS&R, as Kelsey was mentioning. Kim and myself and Zach will take you through the presentation. But before we review the study results, let's take a few minutes to talk about the objectives, the scope of who we surveyed, definitions, which are going to be helpful when we're looking at key findings, and different segments. So the overall objective of the 2018 True Cost of Fraud for Lenders study is to call attention to the threats that lenders face from the rising risk of fraud and to point to the ways that they can optimally protect themselves, especially as they grow into new and different channels and new and different kinds of transaction methods. There is a lot more information. There's a full report. We will not go through all of that today, but that can be available. But during our time today, we will look at the cost of fraud and how that impacts the bottom line. We're going to look at see who gets hit harder by fraud. We're going to talk about factors that drive fraud, and we're going to highlight ways to effectively fight it. We completed an online survey with 186 risk and fraud executives across a variety of lending institutions. You can see those kinds of institutions that are in the center of the slide, a good variety across credit lenders and mortgage companies. And we're also, if you look to the bottom, there are types and sizes of organizations that we got a very good mix of. And we want to review what those mean because we're going to refer to them today. When we talk about digital lenders, we're using that term to refer to those that earn 50% or more of their revenues through remote channels, whether that is an online channel or it is a mobile channel. When we speak about small or mid-sized lenders, we are thinking of those small lenders that would be under 10 million in annual revenues. Mid-size are those that are between 10 and 49 million in annual revenues, and large would be 50 million and a plus. We may also talk about online marketplace lenders, and those are the kinds of lenders that generate and conduct all of their business remotely. When we spoke with executives, it was very important that we were using the same definition of fraud and to make sure that everyone was on the same page. So for this study, fraud is defined as fraudulent and or unauthorized transactions. Fraudulent transactions that are due to identity fraud, which can be the misuse of stolen payments, such as credit cards. Fraudulent request for a return. I did not request this loan type of fraud. Bounced checks. Account takeover by unauthorized persons. And the use of accounts for money laundering. When we do talk about fraud, we are talking about consumer-facing fraud methods. The study does not include insider fraud or employee fraud. And lastly, we are going to be referring to what's called the LexisNexis fraud multiplier. This is going to help us talk about the true cost of fraud. And as its name indicates, it is a multiplier. It means that the cost of fraud is not just that lost value of the loan. It includes a number of other indirect costs that are associated with it, and I'm going to explain those in a few slides. But the net of that is that every $1 of fraud, in terms of the value of a lost loan, the actual cost is going to be higher or multiplied. For this session today, we have organized findings around 5 different top-level findings. So let's review what those are, and then we will go into more detail on them. First and foremost is that the cost and the challenge of fraud continues to grow among U.S. lenders, somewhat more among credit lenders than mortgage firms, which means that the negative impacts of fraud continue to be most severe among creditors, and particularly when we look at large digital firms, again, those firms that are generating the majority of their revenues through a remote channel, as well as those that are conducting mobile transactions or international transactions. Identity fraud and identity verification was a key factor in driving fraud last year, and it continues to be a key factor in driving high fraud volumes and costs, particularly among those digital lenders. And those lenders that are most at risk are not sitting back and doing nothing. They are attempting to prevent fraud. They are doing things and investing to make a better, more efficient way to manage and fight it, but perhaps not optimally. So at the end, we want to show that there are findings that lending institutions that can layer solutions by identity and fraud transaction do experience fewer and false positives and fraud cost. So let's go to the first key finding, and that is that the cost and the challenge of fraud continues to grow among U.S. lenders, somewhat more among credit lenders than mortgage firms, but let's take a look here. The charts here refer to the cost of fraud, and on the right side is the LexisNexis fraud multiplier that I referred to a few moments ago. What it tells us in red, which is for 2018, is that on average, every $1 of fraud ends up costing lenders $3.05 across the board, whether you're credit lenders, whether you're mortgage lenders. And that's up about 8% compared to $2.82 last year. Now, we can break this down, and we can understand what's going on and what's behind that. As you will recall, the cost of fraud is more than just the value of that lost good, that lost loan. It is also made up of indirect fees and interest that could be incurred during the application process or the underwriting or processing stages. It can be fines and legal fees. It can be labor, internal labor costs for detecting, for investigating, for reporting, for recovering fraud. And it can also be external costs that are paid for other outside support for detection and investigation and recovery. Generally, when the fraud multiplier increases, that means that there is at least an increase in those indirect costs that go along with it, which really will impact, of course, the bottom line. And that's the chart that we see on the left side. As fraud cost as a percent of revenues has gone up, you'll see from 1.62% in 2017, it has increased to 1.92%, and that's not insignificant. These are numbers, as I mentioned, for digital and mortgage. They're an average across all lenders. We will look more specifically at different segments. And in particular, we're going to see that increased fraud costs are really being driven. The increase here is really being driven by those that are using digital channels, particularly mobile and with cross-border transactions. Kim, what might you be observing in the marketplace, around the digital channels?
So I found this finding to be very interesting because according to recent research, by 2021, half of all adults worldwide are going to be accessing financial services digitally. And that's just a 53%, or that's an amazing 53% increase over last year. But by 2020, digital lending is projected to account for more than 10% of the U.S. lending market. So if we take that into consideration with that second point around the increased fraud costs being driven by digital channels, it's something we need to pay a lot of attention to.
It really says that we know fraud continues to increase, but this is really a factor that's going to help it rise even more, and really a need for continued and even more sophisticated management of it, it sounds like. Let's take a look at building upon some of the things that we were looking at on the previous chart. We'll break this down between mortgage lenders and credit lenders. So an average monthly fraud volume, which you see on the far left-hand side, in red is the average volume of fraud transactions in a month. That were successful, in gray, are the average volume of fraud attempts that were prevented. And we do see that the credit lenders have significantly more fraud attacks. They also have significantly more successful fraud attempts. And as we move farther right in the chart, we see that while the multiplier on the far right is not that different between mortgage lenders and credit lenders, the impact on the bottom line is much harder to the credit lenders. The fraud as a cost, fraud cost as a percent of revenues is 2.57% for credit lenders and much less for mortgage lenders. And a point here to think about is that since the financial crisis of years past, mortgage lending has really become much more rigorous. So it is much more rigorous than getting a line of credit when it comes to the verification and validation process. There are a lot more verification forms with mortgage lending, and it's a lot less instantaneous. So the credit lenders are much more at risk, and this is one of the factors that might play into that. I would like to turn over to Kim, who will take us through findings for the second key findings.
Thank you, Chris. So our second key finding is that the negative impacts of fraud continue to be most severe for large digital lending firms, particularly those creditors and those with international and mobile transactions. So let's go to the details. So our study found that large digital creditors experience a higher volume of fraud over non-digital creditors, and that includes those attempts that are successful. It was at 32% if we look at the 840 attempts that succeeded compared to the 2,605 in that third column. It just shows that that percentage is much higher. On the second right side of the table, you see the three bars that represent the fraud multiplier, and fraud costs are also higher for digital creditors at $3.47 for every dollar of fraud that they experience. These costs are related to things like labor investigations and external security consulting support. The image that you're looking at right now can also show that as we introduce and pay more attention to the mobile channel, there are other implications. So the mobile channel, including mobile apps, the large digital creditors tend to use those more. They use more mobile web browsers. If you look at the first set of information in the columns, and they also use more branded mobile apps than their mortgage comparisons. So fraudsters are increasingly targeting mobile apps, and digital creditors are reporting that 17% of mobile fraud losses are actually associated with their branded mobile apps. And that was an interesting finding because we typically think that mobile apps are more secure, but there still is added risk there in the mobile channel. Let's go to the next slide. And the final component is international. Large digital lenders with international transactions attribute nearly 40% of fraud losses to business outside of the U.S. This can be seen on the left side in terms of percentages, as well as the actual fraud multiplier is higher for large digital firms with international business. It's $3.59 in comparison to their non-digital, digital mortgage, and digital creditor counterparts that operate solely in the U.S. So now we'll go back to Chris to talk about key finding number 3.
Thank you, Kimberly. Identity fraud and identity verification remain as key factors driving higher fraud volumes and cost among digital lenders. But before we go into this finding, we would like to hear from you. We have a poll question, and that is to understand how you define synthetic identity. So we would ask you to fill out this poll. We'll give you a couple of minutes to do that, but let me read down through the answer categories first. So the question is, how do you define synthetic identity? Theft of a person's identity. This is theft of a person's entire identity. And the fraudster essentially becomes you. Use of multiple persons' identity to form a single fake identity. Use of a person's digital identity, such as their email, their IP address. Combining real and fake identities, which means using some pieces of real information along with fabricated data to form a fake ID. So take a few minutes or take a few seconds to fill this poll out. Now, for those who do not fill the poll out, they will not be able to see the results. So if you do fill it out, you should be able to see the results when they come through. So we have a few more people that are continuing to fill this out. We'll give another few seconds to make sure everyone has had a chance to think through and answer. Looks like we've got most of the answers in. I don't see any other additions here. What you see, if you filled out the results, and I will read them here also for those who didn't and don't see the results, but 30 of you, the majority of you, have indicated that a synthetic identity is combining real and fake identity. Some pieces of information from people's real personal information along with fabricated. We do have, in second place, we've got the use of all fabricated data, and slightly behind that is the use of multiple persons' identities. We had a few who said that it's theft of a person's identity, meaning the entire identity, and also said use of a person's digital identity. And before we look at the next slide, you know that the results here, the answers is that it can be created through one of 3 ways. Taking multiple real persons' information, such as a valid shipping address or social security number or date of birth, none of which would necessarily match any one individual, and putting that into a fake identity. It can be taking one person's real information and combining that with fake identity information. It can be taking information totally fabricated, the last answer also, which is none of it relates to anybody, but it is entirely fabricated. Really thank everyone for participating in that. And the reason that we wanted to have this is our first slide up here is talking about identity fraud and how that accounts for up to half of fraud losses among lenders, with synthetic identity fraud playing a big role for digital creditors and those transacting internationally. You can see that identity fraud accounts for, if you take the identity fraud itself plus the synthetic, you can see you get 47 to 55% of the distribution of fraud losses as indicated by survey participants. And that synthetic identity fraud, which is our third set of columns here, is somewhat more of an issue for the creditors in blue and those generating more revenue through remote channels, the large digital in red. You know, the remote channel online and especially mobile, it's anonymous and it requires much more rigor to identify and to authenticate. Verification is part of taking self-provided data and using that to determine if in fact this person or identity on the other side of that anonymous line is real. Authentication, though, is very much a part of it, to confirm that it's actually Jane Doe who is on the other side. So there's really two parts there. And the nature of synthetic identity is insidious. I think that's the best way to put it. Fraudsters will create an identity that looks and feels very real and will try to get good credit by signing up using that synthetic identity for subscriptions or other kinds of services that a fraudster can pay monthly and make it establish a good payment record, look like a very good customer, and it becomes very difficult then for traditional identity verification checks to really pick up on that. We can see how challenging identity verification is for those using remote channels, i.e. the digital lenders. So on this slide, the large digital creditors, which are in the blue, and the large digital lenders with international transactions, which are the red columns, are significantly more likely to rank identity verification, which is on the far left side of the chart, among their top 3 online and mobile fraud challenges than those that are less likely to conduct less remote channel work. Along with this, there's also on the far right side, you will see particularly those with international work, a lack of specialized tool for international transactions. 41% of international lenders rank this as a top mobile channel. Along with, and again, if we stay right on the mobile channel, 39% of international digital lenders, large digital lenders, and 36% of large digital creditors are indicating that the emergence of new and varied mobile transaction methods are also a challenge. So it's more than one factor hitting those who are operating in the mobile space. This takes us to our fourth finding, which is that the at-risk lending firms that we've been talking about are in fact attempting to prevent fraud, although perhaps not as optimally. Things may not be necessarily working in an optimal way for them. What we see here, and as you already know, fighting fraud is not just about the solutions that help you do that. It's also about the practices and the checks that you put in place to understand fraud and where it's coming from. So tracking fraud cost and attempts is certainly one of those checks in the system. Large digital lenders continue to track fraud costs by both channel, meaning the in-store, online, mobile, as well as payment method, which is the credit, debit card, check, etc. They tend to track both of these much more than non-digital firms. And you can see that down below on the lines, in the blue lines, 60% plus of the large digital lenders are tracking both channel and payment method. Those that are not digital, only a third of them are tracking both of these. So you think about it as a plugging up holes in the dam. If you're not looking at every angle, fraudsters are going to try to find those open areas. If we continue to look at this further, what we see is that large digital lenders also track both prevented and successful fraud by transaction and channel type. So again, understanding where the fraud has been averted and where it hasn't been. Fraudsters will continue to make attempts. So if one is not covering the bases and trying to plug up gaps in access points, fraudsters will just continue to work through those. And solutions, at least one fraud mitigation solution is being used across lenders. We know that the larger the lender and the more that they are in the digital space, we know that there's actually more solutions that are being used. But unfortunately, that doesn't always seem to be helping the accuracy or the efficiency of fraud identification processes. Just as many, if we look at the blue charts here, this is the percent sent for manual review. And there's a sizable portion of those transactions which are alerted as potential fraud that are sent for manual review, even though we have seen solutions are being used and we know that there's tracking of fraud attempts going on. So, this could be a factor of not all kinds of solutions being used, but it could also be a factor of perhaps the right combination of solutions are not being used. Before we look at that, we would like to hear from you again about the kind of fraud mitigation solutions that you use. Please take a moment to fill out this poll for any of these kinds of fraud mitigation solutions that your organization may use. So we have people continuing to fill out. We'll give a few more seconds for people to do so. And it looks like we've gotten most everyone who's going to answer. So the top solutions here we see are device intelligence, a quiz or knowledge base or secrets authentication, and government-issued ID validation are the top solutions that people were mentioning. We have a few more people that came in and they were answering the same solutions. Biometrics capabilities and machine learning capabilities are mentioned not quite as much as the others. So if we go to look at the study findings, and I thank you for everyone who participated, what we see here is that a good share of large digital creditors, those most at risk, they're in the dark blue, are using automated transaction scoring and customer profile databases. But there is inconsistent and sometimes limited use of other advanced verification and authentication solutions, particularly those that would help with unique risk from the mobile channel, such as geolocation or device ID fingerprint. And we see that this pattern also occurs when we look at the large digital creditors compared to the large digital mortgage firms. So, and especially when we look at the large digital creditors who are in the lighter shade, they have higher fraud volumes, they have higher cost, and they are using the mobile channel and they are conducting cross-border transactions. And yet there's fairly limited use of the unique kind of solutions that could help with these specific risk and specific channels. So it suggests that the efforts are not entirely optimized in terms of the types of solutions that are being used or layered. And that's how I'd like to transition this back to Kimberly, who will take us through to Key Finding 5.
So Key Finding 5 shows that lending firms that layer solutions by identity and fraud transactions experience fewer false positives and lower fraud costs. So let's dig into that. Survey participants reported that layering a combination of basic solutions that Chris just spoke about with identity authentication and transactions have the biggest impact to lowering their fraud costs. If we look at the bars, we can see that the true cost of fraud for these individuals, their fraud multiplier, went from $3.47 down to $2.63. And also the average cost as a percent of revenue went down as well. And the more advanced these solutions, the better the impact. So being able to look at more advanced identity and transaction verification solutions had a more positive impact than basic solutions. So I think this brings us to a good spot to be able to start talking about our recommendations. Our first recommendation is that lenders, particularly digital ones, should consider a multi-layered solution approach that attacks different types of fraud. So this requires paying attention to identity fraud as well as transaction-related fraud, as these can be very different and identify very different fraud vectors. So we have seen from the earlier slides that properly layering solutions will reduce the cost of fraud for an organization. And that's really because manual review costs go down and successful fraud attempts and false positives are also reduced. Let's go to the second recommendation. Our second recommendation is when layering solutions, it's important to implement a mix of different ones in order to address the unique risks generated from different channels and from payment methods. And it's really not about the number, but it's the right combination of solutions. And so I can't stress the importance of making sure that you're paying attention to the contact channels that you are interacting with your customers, whether they be digital or non-digital. There's a need to be able to address both the physical and digital identity components of your customers, so understanding not just name, address information, but also how they're interacting online if you are choosing to use a digital channel or with their mobile device. And so these different challenges and risks will require sometimes specific solutions that also support domestic versus international transactions. And our third recommendation is that a multi-layered solution approach is particularly essential for larger digital lenders using mobile channel. We've talked a lot about the risk in order to fight fraud generated by botnets and synthetic identities. So when you're in a mobile environment or any remote environment, you do run a larger risk of not really knowing who you're interacting with. And bots specifically are very challenging because it's just a sheer volume of attacks. When we did our studies for the retail industry, we saw that as much as 90% of traffic on some days is all botnet attacks. So being able to try to do identity verification is very challenging as well. And so paying attention to the mobile channel and trying to address those types of unique challenges is important, and it requires the need for a combination of insights to look at the physical identity as well as the footprint, where the location of the transaction is coming from. Have you seen that device before? I'm going to pass this to Chris back to you, Chris, for the last 3 recommendations.
Thank you, Kimberly. Our 4th recommendation is that small mid-digital lenders do need to remain vigilant against fraud attacks as well. We've talked a lot about large digital to point out the higher risk and the cost, but smaller and mid-digital lenders are also exposed. And fraud risk are not just the domain of large digital firms. While those larger digital firms do experience higher fraud costs, there are still high cost of fraud among small and digital lenders as well. And many of these smaller firms generate nearly all transactions via remote channels. So there's, especially as I go back to the online marketplace lenders that I defined very early on, they're working primarily through online or mobile. So including the use of mobile apps, which especially is appealing to fraudsters and the or underbanked at this point. So the risk mitigation solutions use it's limited more among these small mid lenders, and that continues to put them at risk because they've got the risk by nature of the transaction, but also the limited use of solutions to combat that. And so it is important for them to remain vigilant and, again, especially look at layering in those solutions to address those risks that are posed by the online and the mobile channels, whether that be digital ID, fingerprinting, real-time transaction tracking, geolocation, and so forth. Our 5th recommendation is that lending firms should seek external providers with deep data and analytic resources to most effectively address identity-based fraud challenges. And this particularly includes those conducting international transactions. Identity fraud can be complicated, as we've talked about. There are various layers of mask that the fraudster puts on. There are various connections in the background. Investing in a layered solution approach is going to be much more effective if it's from a solution partner that can also provide the linking capabilities, which identity and match hidden relationships. So what's the connections? It's not just necessarily the person, but it's the ecosystem that that person is operating in, and to shed light on those suspicious activities and transactions where there could be collusion. These patterns are not easily uncovered by a number of the more traditional risk solutions that have been in the market in years past. When we look at international transactions and we look at new privacy rules, especially the GDPR that took effect in the European Union, that's going to make it increasingly difficult for companies to access and store foreign customer data that is essential to effectively identifying and verifying and authenticating, especially if we're talking about digital identity data. So this means that firms will need to rely more on external providers who already have those deep reservoirs of current data on consumers and businesses. And to our last recommendation is that lending firms need to holistically track fraud by both payment and channel type. And that includes the transactions that have been successful and those that have been prevented. It needs to be part of that broader approach that involves fraud detection solutions. Fraud occurs in different ways, as we've talked about. And that creates multiple endpoints and approaches that fraudsters can use to attack. And they will continue to test the weakest links. They will continue to send out click flooding, trying to figure out what they can get through and what is not being detected. So knowing where they've been successful is certainly important for plugging the gaps. But also knowing where they have tried and failed is also important to know in order to maintain that vigilance. But that said, the rise of synthetic identities makes it easier for fraud to go undetected. There are firms, and we've seen this in other research that we've done, other true cost of fraud studies, where executives tell us we're not always sure that the kind of fraud, identity fraud, is a synthetic fraud or not. Sometimes it's we've ruled out everything else and this is what we think. So it can very easily go undetected. Without the aid of risk mitigation solutions that are designed to identify those fraudulent identity characteristics and tracking approaches, lenders are going to miss the clues, and that's going to weaken the